Anish Chandaria, Vice Chairman and Managing Director from Aegis Logistics Limited. Thank you, and over to you, Mr. Chandaria.
Thank you very much. I'll be presenting the Q1 results for FY21. This was an average set of results for Q1 during the height of the lockdown. You will see the impact of the peak lockdown from April to June 2020 in these results. We do expect, however, some improvement in Q2. That's the current quarter, July, August, September, and particularly in the second half of this financial year 2021, FY21, as the lockdown restrictions ease in many states and as some of the new projects come on stream. So I would say that Q1 was which was the peak lockdown period, April, May, June in India, was will be probably the worst quarter of the year, but then things will improve. Total revenues for Q1 was 636 crores versus 1,955 crores a year earlier. Total Ebitda for the group was 118 crores versus 112 crores a year earlier. That's a rise of 5% year on year. The normalized profit before tax, that means excluding the employee stock purchase plan of 42.1 crores, which is a non-cash accounting charge. The normalized profit before tax was 92 crores versus 84 crores a year earlier. That's a rise of 10% year on year. And the normalized profit after tax for Q1 was 79 crores versus 62.3 crores a year earlier, rise of 27% year on year. And finally, the normalized profit after tax after minority interest, that means all profits after tax available to Aegis shareholders, in Q1 was 71.8 crores versus 56.9 crores a year earlier, a rise of 26% year on year. So as I said, an average set of results in Q1 with the normalized net profits after tax up by 26% year on year during this lockdown period, April, May, June 2020. But we do expect some bounce back in the business as COVID restrictions are lifted gradually in India. And as you'll see when I go through the underlying results, the liquid terminal division held up well during Q1, and that supported overall profits for Aegis Group. So now turning to the segment analysis. So as I said, very pleased to report an all-time high for our liquid terminal division during this difficult period of April, May, June. So liquid terminal division revenues were a record 55.4 crores for Q1 versus 49.5 crores a year earlier, a rise of 12%. The Ebitda was particularly good, 39.9 crores for this division, liquid terminal division, versus 32.1 crore a year earlier, a healthy rise of 24% in year-on-year Ebitda for this division. And as I said, this is a really good result for this division, despite COVID, as the business model is storage-based fees, which remain healthy as almost all the tanks in the terminals, in the various terminals, are full, except Pippa. And it's good to see this stable source of profits during this difficult period. Now, turning to gas terminal division, revenues in Q1 were 581 crores versus 1,906 crores a year earlier. That's quite a drop, particularly in our sourcing volumes from our subsidiary in Singapore, as the PSUs, the public sector units, basically stopped many tenders and many spot imports of LPG around May, June, due to the overbooking of cargoes. There was also, of course, a sharp drop, particularly in April, in international LPG prices. So big drop in our sourcing of gas for the public sector, as well as a big drop in prices. You all know that in April there was negative oil prices, crude oil prices. So there were not negative LPG prices, but it fell down to around $238 per ton, for example, in in April, which was, I believe, the lowest international LPG prices since the 1990s. That particularly affected our the revenues for the prices for our sourcing business. Now I'll go through the underlying sales volumes in our key market segments, which will also show the impact of COVID. First, as I normally take you through the key metric of the LPG throughput logistics volumes in our 3 LPG terminals of Mumbai, Pipavav, and Haldia. And this in Q1 was 700,349 metric tons versus 558,066 metric tons a year earlier, a 25% increase year on year. But as I guided in the last earnings call, quarter on quarter, that means comparing this figure of 700,349 metric tons versus Q4 of the previous financial year, that was a small drop of 4% on the last quarter's throughput, Q4, of 728,000 metric tons. So what was happening during this lockdown period to LPG imports and the throughput in our terminals in Aegis? It's a little complex picture. I hinted at it in the last earnings call, but I thought it might be helpful for many of you for me to go through the key things that were going on the ground during this peak lockdown period, April, May, June. So the basic headline is there was an oversupply of LPG during this quarter in India. The PSUs had overbooked imports, particularly in the month of April. There was a very strong expectation from the PSUs for demand during the April month, because they were anticipating the Prime Minister's new free LPG cylinder scheme during the lockdown. This was announced by the government of India I think it was shortly from the start of the lockdown at the end of March, early April, that the government would be giving customers in India, domestic customers, 3 free LPG cylinders during this lockdown period. So obviously in anticipation of that, the PSUs expected a big rise in demand. However, this did not actually take place. Demand remained at normal levels despite this free cylinder scheme. So there was, as a result, a pile-up of ships at ports, and with refineries restarting production of LPG in May, there was an oversupply. So lots of high inventories were built up, especially in the West Coast terminals and the South terminals. East Coast terminals were actually okay, but the overestimation of demand leading to higher imports meant very high inventories in the West Coast terminals and the South in this Q1. And finally, just like Aegis' own retail division, during the lockdown, the PSUs themselves saw a sharp drop-off in their commercial LPG sales in hotels, restaurants, industrial sales, and the auto gas volumes during the peak lockdown period, April to June, because obviously no hotels and restaurants were operating, no auto gas sales pretty much, because there was no movement of cars or taxis, auto rickshaws, and obviously industry was also shut down, particularly in the month of April. So therefore, their own demand for LPG throughput from the Aegis terminals for their own retailing was less than normal. So that's what happened. But despite that, we still were able to make 700,349 metric tons in Q1. As I said, a 4% drop quarter on quarter, a small drop, but still a 25% increase year on year. Next segment is the Aegis' own, I'm coming to the Aegis' own retail volume, starting with our bulk industrial sales, distribution to industrial customers of LPG. Q1 was 7,414 metric ton, versus 26,277 metric tons a year earlier. That's a sharp drop of 72% year on year, as most industry was shut down during the quarter. Auto gas was also down, only 2,944 metric tons in Q1 versus 6,442 metric tons a year earlier. That's a drop of 54% year on year. As I said, no movement of auto rickshaws, taxis, and private cars, particularly in April and May. Then we come to the commercial, our commercial and domestic LPG segment, market segment, which is the Aegis branded LPG cylinders, pure gas, Aegis branded pure gas in the commercial segment, hotels, restaurants, and Chota Sikandar for the domestic segment. Sales in Q1 were 2,553 metric tons versus 4,537 metric tons a year earlier. That's a drop of 44% year on year. Again, to repeat, all hotels, restaurant sales, migrant labor sales also were down for the domestic segment due to the lockdown. And finally, as far as sourcing is concerned, as I mentioned, only 158,287 metric tons in 3 months in quarter one of sales from our subsidiary in Singapore, Aegis Group International, versus 452,471 metric tons a year earlier, due to the sharp drop in PSU spot imports, particularly from May and June. April was a strong month, but then May and June really dropped off as they had overbooked imports. So, to summarize our gas division, a small drop of 3% a small drop of 4% in our LPG throughput volumes, which still represent around 80% of our EBITDA for the gas division, that the LPG throughput volumes. That's a very key metric. But a small drop of 3% in LPG throughput volumes quarter on quarter. Still a rise of 25% year on year, but 700,000 metric tons for quarter one. But we were, despite that rise, we were still hit badly in our retail sales volumes during the lockdown. And as a result of these two factors, during this period in quarter one, we did see a 3% drop in EBITDA for the gas division year on year, which is the first time for some years that the gas division has stalled in a particular quarter. I don't remember this for many years, but obviously this, I think most of you will agree, this is understandable during the peak lockdown period of April, May, June. A 3% drop in EBITDA in the gas division, I would argue, is not too bad in the circumstances of this peak lockdown period. But the liquid terminal division did very well. In fact, we saw a 24% rise in EBITDA for quarter one, which supported the overall profits for the group. Now let me come to the projects update, the impact of COVID that we expect during future quarters, and obviously the outlook for the rest of the year FY21. Let me start with the project update, and then I'll go on to the outlook for sales and profits during the rest of the year. Starting with the Chakan pipeline for our Mumbai terminal. This is the pipeline connecting our Mumbai LPG terminal to Uran and then Chakan on the outskirts of Pune, which most of you will recall is a very strategic pipeline for the future. So I'm pleased to inform you that after the commissioning in June, the throughput through the pipeline has now gone up to every other day in the month of July. This is the current month, July, that we started it in June, and now the throughput has actually reached once every other day through that pipeline. So basically 15 days in July there was throughput. Of course, there remains tanker movement, road tanker movement as well. And as I said in the last earnings call, we expect the maximum capacity of this pipeline to be reached from October onwards, and that's as a result of still some technical work with boosting the capacity, which both HPCL and Aegis is doing. And we expect that maximum capacity to be reached from October onwards, and that will add to earnings growth from Q3 onwards of this financial year. Q3, Q4 will be boosted significantly by additional volumes for our Mumbai terminal through this pipeline. The second project, which is coming on stream in Q3, is the railway gantry project in Pipavav. As most of you recall, this again is a very strategic project which we've been working on for a number of years, but it's coming close to the end now. This project, this will connect up our Pipavav LPG terminal by rail, particularly to the north of India, to bottling plants in the north of India. The project is going on in full swing. I'm very, very happy that since the month of April, when we were able to restart that project, the project has been going on full swing, and we expect actually to start the rail movement of LPG from Q3 from Pipavav. And again, just like the Chakan pipeline, we expect this to significantly boost earnings growth from Q3 onwards, with more throughput in our Pipavav terminal from Q3 onwards, when we are able to commission that railway gantry. So those are two important projects which are going to boost second half earnings in FY21. Next is the Kandla LPG project, which is the 4 million ton annual capacity LPG terminal that we are building in Kandla. That project is also in full swing, and as I said in the last earnings call, we expect to commission that in Q4 of FY21, with a full impact of earnings growth next year, FY22. But we expect to commission that in January, February, March of 2021. Next, some liquid terminal projects. The Mangalore liquid terminal project, expansion project of 50,000 kiloliters that we're building in Mangalore. That project is also on track. Very happy that that project is also in full swing. We expect this to be fully completed by Q4 of FY21. That is the last quarter of this financial year, and impact on earnings in FY22. I'm very happy to say that the 50,000 kiloliters has already been pre-sold. That means all the tanks have already been pretty much pre-booked by customers, which gives you a good indication of demand for this important terminal expansion in Mangalore. You will recall that we already have a 25,000 kiloliter terminal in Mangalore. This is an expansion of another 50,000, so that is full as well, the existing terminal, but this is additional capacity which is already pre-booked, pre-sold, and that's a good sign. And I actually think this will be a pretty good revenue and profit generator for the liquid terminal division in FY22, because of some of the products that we're going to be handling there, including bitumen, for example, which goes into roads, etc., which are higher margin products. So it's a good product mix there, and it'll be a successful launch when we are able to commission that by Q4 of FY21. So that will impact on next year's earnings. Also, there is a expansion in our Haldia terminal of another 12,000 kiloliter liquid, small expansion, but we expect to complete this. We expect to complete this in the current quarter by Q2. So there will be an impact on liquid terminal division earnings from Q3 of this year from Haldia, and I think these are the main projects. So I think the summary on the projects is the Chakan pipeline as well as the Pipavav railway gantry is going to be a significant boost to sales volumes, throughput volumes from Q3 onwards in this financial year onwards, and that is not really affected by COVID particularly. Irrespective of that, these projects are coming on stream, and we've been working on these projects for a number of years. It's good to see them coming on stream by Q3 of this year. and the other projects which I mentioned, including liquid projects and the Kanda LPG, are going to really impact, particularly in the next financial year's earnings growth, FY22. So now let me come last to the outlook as we see it for FY21 for the rest of the financial year. Despite the challenges of COVID seen especially in Q1, which I said was the peak lockdown period and probably the most difficult period for most companies, including Aegis, I think we did okay. As I said, it was a okay set of results in Q1, despite that the impact of COVID. But the good news is, at least we expect some improvement in LPG sales volumes, particularly in starting in Q2, in this current quarter, July, August, September. So I believe that Q2 will be better in terms of LPG sales volumes compared to Q1. And then, as I said, Q3 and Q4, we do expect a jump in LPG throughput volumes because of the Chakan pipeline project maximum capacity being reached and the Pipavav railway gantry. And that's going to impact on full year earnings. But as I said, it'll probably be more from Q3 and Q4. The retail LPG segment is going to take some more time to bounce back. As you all know, COVID restrictions it's complex pictures in different states. Restrictions are loosened sometimes in some states, and then they're suddenly reimposed. Local lockdowns are reimposed in states. I give you the example of Karnataka, which was fully opened up in June, including important cities like Bangalore. We saw quite a big bounce back, in fact, in the month of June, for example, in auto gas sales in the state of Karnataka, which is our most important state. I get the weekly figures on auto gas from our head of retail. But then suddenly in the month of July, they went back into some COVID restrictions, and therefore movement of taxis, auto rickshaws, etc., declined in July. So there are it's difficult for us to forecast what's going to happen with the retail LPG segment, which is a high margin segment for Aegis. So it does have an impact on Ebitda for the gas division. But look, irrespective of COVID, we do expect, as I said, some boost to earnings growth in FY21, especially in Q3 and Q4, due to the liquid terminal business has remained strong during COVID, and we expect new capacity also coming on stream in Mangalore and Haldia, etc. We expect that good performance of liquid terminal division to continue irrespective of COVID restrictions because of the business model that we have over there, which is storage-based fees. And I believe that that is going to support growth for Aegis Group as a whole in FY21. Chakan pipeline, as I said, will add to the Mumbai terminal throughput from Q3 onwards. The Pipavav railway gantry will add to LPG throughput from Q3 onwards as well. So those are the three key factors which I think will keep profits growth going in this year in FY21. But I think it's difficult. The headwinds of the COVID restrictions on the retail LPG segment are still expected, obviously, to impact the retail division profits for FY21. But while all this goes on, Aegis will continue to grow and invest in our projects for the year ahead. We have a very strong balance sheet with very little debt, and we are producing strong free cash flows from all the profits that I mentioned. And so that's good. So we continue to grow and invest for the future. And final 2 points. Let me just talk a little bit about what the industry expects for LPG demand in India, consumption of LPG in India as a whole. The government is still projecting a 6% growth in consumption of LPG for this financial year, FY21. So around 26.5 million metric tons versus 25 million metric tons in FY20. and imports will obviously grow accordingly as well. So the overall picture for LPG demand, despite some volatile period, April, May, June, with PSUs overbooking and all that, but despite that, for the year as a whole, they expect a fairly normal 6% growth in consumption of LPG for the year as a whole. So our plans to boost LPG handling capacity, our own Aegis LPG handling capacity, from 5 million metric tons currently to 9.2 million metric tons by next year, by FY22, remain on track. Obviously, that is mostly the Kandla LPG project and some expansion in Pippa as well. So we continue to remain bullish about LPG demand and imports, not only this year, but years ahead, and which is why we're increasing capacity from 5 million metric tons to 9.2 million tons, because the case for LPG, particularly domestic household cooking gas, remains a long-term and very strong case, and that's why we are continuing to invest in building our capacity. And finally, we continue to massively build up our national retail distribution network, so that when COVID restrictions are over, we stand ready to expand our retail sales volumes. As we put in our investor presentation for the last few quarters, we have a national plan for building a national network for our retail sales retail market division. And we are currently in 7 states, but we're building that out to 20 states, which is virtually national from our current 7 states. And I have been discussing every week with our retail division on the phone how important during this lockdown period it is to continue signing up new dealers, new distributors, new dealers, new auto gas stations we continue to build, and also new sales officers as well, which is very important because ultimately it's boots on the ground which increases our presence in those 20 states from 7. And we are actually hiring. We are hiring a lot of people, which is good at a time of increased unemployment in India, that we are expanding our retail distribution network, because this is as good a moment as ever to keep working on building that distribution network. Because one day, hotels, restaurants, auto rickshaws, taxis, we in India will go back to at least some bounce back from where we are today, certainly where we were in the peak lockdown, April, May, June. And that's very important because, as I've been emphasizing, we expect this retail LPG division of Aegis, which is high margins, we expect this to be a big engine of growth. Apart from the expansion of our LPG terminal capacity, we expect the second big engine of growth for many years ahead, not only the next 5 years, but next 10 years and beyond, to be the Aegis branded LPG, the retail segment in industrial sales, commercial sales, that means hotels, restaurants, and the domestic LPG segment as well. We expect this to be a major engine of growth for many years to come, 5 years, 10 years, and more. And that's why even during this difficult time in India, when the economy is down, but we are continuing to invest and build out our distribution network. Okay, that completes my presentation. We can now take some questions.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Jiten Doshi from Enam Asset Management. Please go ahead.
Hi, Anish.
Hi, good morning.
Congratulations on a decent set of numbers in a very challenging environment. Now, I think, I'm going to straight jump into the future because I think there's very little visibility of what's happening in the current year 21, F21. I believe you are very bullish on the business and hence you're going ahead with a lot of capex even in this environment. So just to understand from you, if your ultimate capacity in the gas division should be about over 12 million, and I think you're also looking at rapid expansion on the liquid side. If I look at your next 5 years cash flows, you're going to accrue at least 500 million cash. What is it beyond this that the company is looking at? Because you don't have any debt. I think your projects are all well funded, and you're already on sort of course to execute what you are having on hand. So what are the next big areas that you're seeing for growth with this kind of cash that's going to come into the company?
Yes, you have raised this with me a few times, so I'll give the same answer. You're right about our big increase in capacity. Of course, in LPG, for example, in the next 5 years. Right now, publicly, we have said that we are going from 5 million to 9.2. But we will, and that's in the current plans, etc. But as I said, there is further, during the next 5 years, there is further debottlenecking that we're going to do. That means we propose increasing our capacity even in existing terminals like Mumbai, like Haldia, and Pipavav as well. So that is one part of the expansion, that we, even though there are existing terminals, even in those locations, because we see natural growth of imports, we actually are right now working on various projects. Those are not yet announced, but I've certainly made it clear that we are going to be looking at increasing capacity, even beyond the current 9.2 million tons that we have planned in those. So those are projects there. And some of those projects may not just be building more tanks. Some of those projects are maybe making sure that there's more evacuation options, which is a very crucial part, which may mean railway connectivity, which may mean more pipelines, or even in Haldia, what I did say about 6 months ago, that we are, for example, exploring the possibility of barge movement through rivers. So there are a number of projects, and as they come forward, those are not just simply building more storage tanks for LPG, but they could involve that. They could also involve more evacuation options. So that's one part of it. As and when those projects are ready, of course, we will bring it to the Aegis board, and then ultimately we will announce it to investors. And as you know, we are working right now during this lockdown period. We've been working on one additional LPG terminal in the south, which is our remaining terminal that we need to build to kind of complete our necklace of LPG terminals. We have not yet got the land over there, and we're working on that, and that is why it's not possible to say what that is. So that is the kind of capex program that we have in the existing LPG terminal business, as far as that is concerned. We do also have, over the next 5 years and 10 years and beyond, a very big plan and actually I would emphasize that is probably one of the biggest growth engines going forward 5-10 years, as I said, in the retail LPG division. That means a series of bottling plants, LPG bottling plants. We have got a plan from our current 13 bottling plants that we are currently using in Aegis to go up to 37 bottling plants, including buying land in certain key locations, etc. This is some of the things that you need to do in order to build that national retail distribution network. So there will be some capital expenditure involved there. By the way, in that we are not only building greenfield bottling plants, but because there are distressed assets out there, bottling plants, we are actually taking advantage of that and buying up those bottling plants. I believe for example, that we're working on 2 currently. It takes a long time, unfortunately, working with the banks and financial institutions to go through all the bureaucracy of buying those. But for example, we are currently buying that. So and then of course building out the auto gas stations and the network, and then the dealers. Now building out the auto gas stations is not a high capex thing, and even the building the dealer distribution network in cases of for the commercial business, that is not a high capex, but it is because it's franchised. But there is some small capex involved in terms of building out that as well, particularly on the marketing. So that is the picture for the next 5 years. And as far as and also there will be an investment in marketing. Okay, it's not what we call capex in equipment, but we will be investing more into building up the Aegis LPG brand. So that will go in the P&L. And these days, of course, we do use different types of marketing, particularly digital marketing, etc., which is much lower cost than the old style marketing. Anyway, that's the next 5 years.
So, Anish, you've still not answered my question. Last year, you did a volume of 3 million, and you had an EBITDA in the gas division of about more than 460 crores. And your retail is only going to increase, which means your mix is going to get better. So probably at 9 or 10 million, you'll do an EBITDA of nearly 2,000 crores. So if I just extrapolate that to the next 5 years, there is going to be at least more than 3,000 crores of 3,500 crores of cash that's visible to anybody who's just doing his math correctly. So what you gave me an account for is not more than 500 or 1,000 crores. So what happens to the other 2,500 crores? And what happens to the big picture? That's because I think you are in a very super period of time where you can really change the orbit and actually grow exponentially into something else also without leveraging your balance sheet. So that's the answer we are seeking. These are the same businesses that you're talking about.
Yeah, I'm not going to answer it in any detail, but I will give you some at least indication, because this is the same thing I've told you offline, which is that because I've been talking about the next 5 years, and broadly, yes, we are going to be strongly cash generative, etc. The numbers maybe we can argue about, but anyway. But we are definitely examining, and I have nothing more details to give, that after 5 years, where do we go with all that strong profits and cash flow being generated? And what I can indicate is we are going to stick within the terminal space, because that is our core competence. We are not going to be investing in anything else. So 2 things, I can give you a hint. We are looking at some acquisitions because we do believe nothing specific right now. That's why I'm just giving an indication. But there is possible consolidation particularly in the liquid terminals space because there are distressed companies out there as well. So that is one area that we're looking at. And then as far as further expansion is concerned, beyond LPG, we are looking at some options. Again, let me say it would be in the field of terminals and other types of gases, not LPG. But using the core skills that we have. There are many other gases, as you know, not just LPG. But that's all I will say right now. And obviously, some of those projects will require large capex if they go forward. But they would. What I'm assuring investors is that we are certainly working on those things right now, because one has to plan any kind of diversification beyond our existing 2 divisions of LPG and liquids. We have to plan that now well in advance. So we are working on that, and I've certainly indicated that to you offline, but I will not give any more specifics.
Sure. My second and last question is, what is the targeted ROI, the minimum that you look at when you're looking at all of this? Because today you have a very healthy return on capital employed. Would you be able to maintain it or better it as you go forward with the product mix changing?
I think the honest answer to that is the LPG business is a very super high return on invested capital. I believe, and I checked the figures last week with our finance department, I believe that in the gas division we are currently, if you look at the average of the last 4 or 5 years, we're currently operating at something like 40% pre-tax, 40% return on invested capital. So in the gas division, in the liquid terminal division, we are around 20%, around 18 to 20%. So the blended return on invested capital for the company is a blend of those two. So I think it's unlikely. I can't say for sure. It's unlikely that other types of projects that will be able to achieve 40% plus kind of return on invested. That is an unusually high profitability in the LPG division because of the nature of the industry dynamics. But I think what we would be targeting, given that we expect our weighted average cost of capital in Aegis is around, we estimate is around 12%. We would normally look at projects in this kind of 20 to 25% range. That would be what we would be looking at.
Fantastic.
Yeah.
Fantastic.
So, I don't think 40% plus is realistic for every.
So the blended, as long as the 40% business is growing, your blended number will always be higher than 30. So that's important.
That's what we are hoping, and of course, particularly with the retail LPG division, which is very low, the capital employed is very low in that retail division and very high margin. The more we can grow that, that will support earnings growth for long years to come in terms of the LPG division. So that will continue to grow, and that's how we are planning.
Thank you so much, and wishing you all the best. Thank you. Stay safe and stay healthy. Thank you.
Thank you. We take the next question from the line of Deepesh Kashyap from Equirus Securities. Please go ahead.
Yeah, hi sir. Thank you for taking my questions. I have two quick ones. So the volumes were very low in the distribution business in this quarter, but what is the EBITDA per ton that you made in the distribution business, given that the LPG import prices are very low?
So the Ebitda that we made in Q1 remained stable, even though the sales were very low, because we didn't reduce prices expecting that actually there'll be more sales volumes. There was no demand because of the restrictions. So the margins were stable, but obviously because the sales volumes were very low, didn't have much impact on profits in this quarter. But we maintained margins. We've always one of the beauties of this retail division is that we have stable margins, and so LPG prices fell a lot. As I said, the international LPG prices fell a lot. We reduced our prices commensurately. We passed that on. Theoretically, that's what we did, and the margins were stable because the costs had fallen. But obviously the sales were down heavily because of the COVID restrictions. So stable margins.
But sir, in the auto LPG division, if I look at the LPG retail numbers, that are like pretty stable, right? The petrol, that's a 40% discount to petrol price, right? So that has not fallen. But your import prices have obviously fallen a lot. So I think the normal 10,000 per ton EBITDA that you used to talk about, that must have increased, right?
No, I think the actual margins, and I have the figures for its average is around 10,000 rupees a ton. It was lower before, but I said for the last few quarters it's averaging around that. It might swing a little bit, but anyway, it's theoretical because we had very small sales of auto gas. So these are all theoretical in the sense that there were actually very little sales because there was nobody buying.
Understood. So second question is that I see the interest expense has dropped by 3 crores in this quarter. Can you please highlight what led to that and what should be the going forward interest expenses?
Yeah, actually I asked the same question to my CFO, so maybe he can answer. Murad, why don't you answer on the interest expense, the same answer you gave me?
Yeah, we are building cash and they are generating income. Plus the interest cost has fallen drastically as far as we are concerned. So all the new loans are coming sub, between 7% odd, when hitherto in the previous year it was 9% plus. So falling interest rates and building up the cash balance which we have, is leading to practically nil interest cost net, if you look at it. And that's how the trend is, I believe, would be going forward. Hello?
Yeah.
Yeah.
So you may go ahead with that question. Thank you. Next question is from the line of Rajendra Mishra from IDFC Mutual Fund. Please go ahead.
Hi. Thanks for taking my question. I have just a couple of queries just to understand that. So one is this LPG terminal which we have or which you're planning. So 5 will go to 9. So this is considered in the LPG gas division, or is it considered in the liquid terminal division?
No, the increase to 9.2 million is the gas division. That's only the gas division. Liquid terminal is something different. But what I referred to was our increase in the LPG terminal capacity from 5 billion to 9.2. That's gas.
Okay. So this entire 9 will be considered in the gas division revenues, right?
Yeah, that's right. And that's the capacity. And then the revenues are how much LPG you throughput. So do you throughput 3 million, which is what we did last year? Out of that 5 million capacity, you throughput 4 million, 5 million. That's how the revenues come.
Okay. And second, in the same thing is this LPG terminal division, whatever we have is entirely captive, or do we also do third party throughput?
As far as LPG is concerned?
Yeah.
Actually, the whole point of the LPG terminal is it's open user. So we handle for anybody who wants to import. The captive part, which is our retail division, is a smaller part of volumes, maybe as little as 10% of our volumes, or actually even less than that. Sorry. So it's an actual open user terminal. The main customers are the PSUs. That means IOC, HPCL, BPCL. We also have some industrial customers, but the main customers are third party, and that's how we charge them fees, throughput fees for handling the LPG for them. That's how we make money. So It's the opposite of what you said. It's actually not captive. It's open user.
Understood. So you're saying out of this 5, only 10% is currently used captive, and 90% is basically on open use basis.
It may even be less than 10% in terms of captive.
And last thing is, if you could just give so you shared some capex plans and project updates on a current basis, and also maybe once these investments come online. So maybe on FY20 basis and FY21 basis, if we can have a capex split between the two divisions. So for overall capex, how much is or overall gross block, how much is into?
Let me cover some of that, and then Murad can comment if I've left anything out. So in terms of the current projects that are going on, and I'll just quickly list them, you can write them down. So this is currently going on. There's a 35 crore project for the Mangalore liquid terminal, the 50,000 liters, 35 crores. That's going on right now, so we're spending that money. That's already planned. That capex already planned for this year. There is a small expansion in Haldia, which is 10 crores for the 12,000 kiloliter project, 10 crores. The railway gantry in Pipau is and the additional spheres project is 75 crores capex.
Okay.
The LPG thing, and that is going on right now. And then finally, the capex is in Kandla, that LPG terminal, the big LPG terminal, the 4 million ton throughput capacity terminal, is 350 crores. That is also going on. So that capex, some of those projects have been going on since last year, like Kandla. Some of them are this year. So the capex will, and then some of that capex the amounts will still go into even the next financial year. So between between FY20, that was the last year, and FY21, the current year, bulk of this capex that I just mentioned would be carried out. So far, we have not mentioned any other capex for FY22 or FY23, but I I just said to Jiten Doshi of INAM that yes, we are currently working on further capex for FY22 and FY23, particularly, and FY24 and FY25, particularly for the next 4 years. We haven't yet announced what those projects are, but I gave an indication that further capex will be in debottlenecking of the Haldia, Pipavav, and Mumbai terminals, LPG terminals. There is a project that we're working on for a new terminal, a greenfield LPG terminal in the south, and then 30 more bottling plants, going up to 37 bottling plants, some of which will be acquisition, some of which will be greenfield projects, etc. And then possibly some more small liquid terminal expansions, but probably in the existing terminals, particularly places like Haldia. So that's basically the plan for capex for the next 5 years, including FY20, the last year, including this year. I've given you the figures, and then future capex to be announced.
And last thing, this distribution network that you plan to build across 21 states, what is the date by which you want to complete this, or it's open-ended?
It's open-ended. It really is open-ended because we don't stop after 5 years. But we have approved a marketing plan and business plan for our LPG division, which I and my brother Raj approved as co-CEOs. We approved this I think it was in February of this year, 2020. Seems like a long time ago. And that is in our investor presentation on page 22, if you're interested. That gives the goals and objectives of that 5-year growth plan. But that will get us up to 5 years. After that, we will continue growing that national distribution network. As I said, the good news is it's not very high in capex. It's very high in margin, so it's a beautiful business. But the most important thing that we need to do is build out the distribution network, the dealer distribution network, appoint those dealers, which takes time, build those auto gas stations, which takes time, and also most important is two other things, which I don't normally emphasize, but I would like to emphasize, which is invest in manpower. We actually have to appoint area sales managers for every state, which we are in the process of doing, almost complete, in fact, for those 20 states. We have to appoint territory sales managers within those states. These are permanent employees of Aegis. And we also have to appoint sales officers. These are the sales reps who go and actually service the shops, the retail outlets, the Kirana shops that we are selling the domestic Chota Sikandar brand, etc. So there's a lot of hiring that we are doing, which is good for at a time like this when people need jobs. And we are actually getting a lot of resumes. So that's an investment, and also investing in marketing, which is going to be required to build the brand of Aegis, Chota Sikandar and Pure Gas in the commercial segment. And so those are not capex, but these are investments which do go into our expenses in the P&L, but they are investments which will result in returns as we build out that retail sales volumes.
Understood. Great. So thank you so much for the insights, and all the best. And keep safe.
Thank you. We take the next question from the line of Pranav Mehta from ValueQuest. Please go ahead.
Yeah. Yes, sir. Congratulations for good performance in a tough quarter.
Thank you.
So the first question is on our gas throughput business. So, like you have laid out the near-term triggers for Mumbai and Pipavav, similarly, can you just throw some light on the triggers for the Haldia terminal? So we have seen great ramp up in the last couple of years, but now to take it to the next level, what kind of triggers do you see, especially in the light of the BPCL's terminal also, I'm assuming will be operational within the next 12 months. So what are the plans there? That's the first thing. And the second question is on the liquid division. So do we see that these kind of volumes can be sustained here? Because like in the Q4 call, you did allude to expectation of some softness in demand from domestic chemical industry, etc., due to COVID. So, but our performance has been very good. So, do we expect to sustain these kind of volumes in the liquid side of the business? These are my two questions.
Thank you. Both good questions. I appreciate them. As far as the Haldia LPG is concerned, yes, you're right that the BPCL terminal, which of course was stopped during the lockdown, but now they've restarted the work. We would expect that to be commissioned perhaps in the next 6 months, and the work is ongoing. However, this has been planned because our anchor customer is HPCL, and what I've mentioned many times is that they are currently operating their bottling plant in a place called Panagar, only at 50% capacity utilization. This is the largest bottling plant in the country and in the continent of Asia. It can consume 500,000 tons of LPG. They are currently only operating that at 50% capacity utilization. It was commissioned last year, and they've built up 50%. Not because they can't operate at full capacity, but because HPCL is actually building out their distribution network, their dealer network, their cylinder penetration into northeast of India and Bengal particularly. So we are currently planning. Our marketing team has planned that in their budget, that maybe currently the throughput in Haldia is about 80% HPCL, 20% BPCL, that when BPCL goes out, that 20% will be taken up by further expansion or further capacity utilization of Panagar. In other words, HPCL will take over that. That's what we're currently planning. Now, I have to tell you that despite this difficult quarter, Q1, the Haldia terminal was actually, the East Coast was actually doing record amounts. So, you know, the West Coast terminals were a little small drop, as I said, in throughput, but the Haldia terminal was doing great. So that just shows you that demand, where remember the penetration of LPG is lower than the national average in the northeast, the states of Bihar and West Bengal and Odisha. They are making great progress, HPCL, in building out that distribution network. And so at the moment, we have a total potential capacity, throughput capacity of 2.5 million tons in Haldia. I will not break out the exact figure for this year that we expect, but we're still not there at 2.5 million. But we are operating the Haldia terminal at much, much higher volumes than we had budgeted even for this year. And yes, even then taking into account BPCL going out sometime in the next 6 months. So I think the answer to the Haldia question is the progress is good in Haldia in terms of LPG throughput volumes, particularly from HPCL as they build out the distribution network and as they raise the capacity utilization of that Panagar bottling plant. As far as the liquid volumes are concerned, yes, you are quite right to remind me that in the last earnings call, which was only a month ago, I was suggesting that maybe there might be some softness going forward in the liquid terminal division this year due to impact on chemicals, etc. Well, look, I have to say, surprisingly, and I talk regularly to our liquid terminal division marketing team, surprisingly, business has remained good in all the terminals, with the exception of Pippa, which remains at a low capacity utilization. But all the other terminals, whether it's Kandla, whether it's Bombay, whether it's Haldia, whether it's Mangalore, whether it's Kochi, has remained strong. And so at the moment, and you can ask me this question again after the Q2 earnings, but and we just had July, for example, business is actually holding up very well. It could be that because the business model here is storage-based fees rather than throughput, it's you know, the customers, whether they're chemical manufacturers, whether they're traders, whether they're even the PSUs, the HPCL, BPCL, etc., petroleum, they still need the storage because they need to store those inventories, and we get paid as long as they store it. So almost all the tanks are full, and so I think that business has held up surprisingly well. and petrochemical storage, chemical storage, as well as petroleum storage, because the customers need storage. Even if the goods are not moving quite, the evacuation, the throughput in this business is not moving quite as fast as it used to be because of COVID. But despite that, they still need to store their inventories, and so it's a surprisingly good result. And as you rightly said, very pleased to see record set of results. That is a proof in Q1 during the height of the lockdown that actually we saw a 24% rise in Ebitda in that division. So at the moment, actually, I would like to change slightly the guidance that I was sales guidance that I was talking about in the last earnings call. Obviously, it's difficult to predict, but we can talk quarter by quarter. But at the moment, that business is actually looking surprisingly good.
All right. Thanks, and all the best.
Thank you. We take the next question from the line of Chirag from Budrani Finance. Please go ahead.
Sir, just wanted to understand, since Mumbai and Pipavav is going to see a growth in volumes, of what is it now and what is it expected from second half of this year?
Well, I have put a very nice slide on page 20 of our investor presentation, which I'm reading out now, so I'll just stick to that, which was a slide which we prepared, I think, a few months ago, pre-lockdown, and that has not changed. So the slide is called The Path to Increasing LPG Throughput Volumes. The first one is about what do we expect from that Uran-Chakan LPG pipeline for the Bombay terminal. And I say in this slide that we expect on an annualized basis a potential incremental volumes of 500,000 tons per year, 500,000 tons per year. I think you can divide it by 4 to take it into quarters, which I believe comes to potentially another 125,000 tons per quarter when that Uran-Chakan LPG pipeline reaches maximum capacity. So I think we fully expect that, because the significance of this pipeline is that, of course, and that figure that I put in the slide of 500,000 tons is not come by magic. It is based on what we have discussed with the customers, HPCL, BPCL, IOC, as to how much they could use. Okay, so that's another 125,000 tons per quarter potentially from the Uran LPG pipeline. The railway interconnectivity in Pipavav, again from the slide, I said once that railway connectivity is ready, we expect potential incremental volumes of 0.3 to 0.5 million metric tons per year. And that project will be completed in Q3 of FY21. So that means an additional, again, that's annualized, so an additional 100,000 to 125,000 tons per quarter from the Pipavav. Okay. And then, of course, we have the new LPG terminal at Kandla, which is also on the slide. That will come FY22, and we expect another first-year budget of 1 million tons for the year. So that gives you a good indication. It's on the slide.
Okay. So this Kochi liquid terminal would be ready by when?
That is going a little slower. It's a small expansion of 20,000 kiloliters. 1 minute, let me open my slide from my board presentation yesterday. Let me just, that's this 20,000 kiloliters project, and it's a small project of 15 crores. So we currently expect that to be completed by the end of this year, FY21. It's in progress. But I would say that the Mangalore expansion and the Haldia expansions are currently, should we say, more prioritized because the demand is very high there. The Kochi one, which we have planned 20,000 kiloliters, is expected to complete at the end of this year, but that is a lower priority right now than the other two projects.
But given your thirst on retail, so 2-3 years down the line, where do we see this auto gas station and commercial distributors from current level?
So what again, if I can refer you to the slide on which you can look at later, I try to put it there in black and white for everyone on page 22. So in auto gas stations, and again I'm reading from the slide, we are currently at 118 stations over 8 states. Actually, I said 7 states. we expect to grow that over the next 5 years to 200 stations over 20 states. Okay, so that's a very clear target. And I have put there in the slide other things as far as the distribution network for commercial LPG and the domestic LPG and the LPG bottling plants in that slide. But just to give you a sense, in the cylinder market, which is the commercial LPG and domestic LPG, we had an excellent Q4, for example, which is a record, and we were going great guns until this lockdown happened in Q1. But we have bold plans to increase the sales volumes there over the next 5 years, but still taking a very small market share. Would you believe our market share in India in 5 years' time will be 1% market share? In other words, the rest of the market will be IOC, HPCL, BPCL. So even though that 1% market share sounds very small, actually it translates into hundreds of thousands of metric tons per year in that segment of commercial and domestic LPG, multiplied by a margin of around 3,000 to 5,000 rupees a ton. So that's just in the commercial and domestic LPG. That's the marketing plan that we have, and then auto gas is separate. So I think even though 1% market share sounds very small, it's still big volumes, and they can have a big impact on profits.
From your product mix, where do you see this contribution of retail LPG in your gas contribution? I mean, would it be what? It will go to 20%, 30%? Where do you see it?
Well, right now, it's actually gone up to around, let's not take Q1, which was an unusual quarter because of the drop in retail sales. But if you take the average of the last year or so, 80% of the profits pretty much is the terminal, of the gas division EBITDA. 80%, as I said, is the throughput logistics from the terminals, right? And not quite 20%, but it might even be 17-18% is coming from the retail division, and the balance 2-3% is from the sourcing volumes in Singapore. Okay, so that's roughly where it is. I would expect that to increase gradually as we build up the retail volumes. Difficult to give a precise forecast, but I would probably expect that 17-18% probably to go up to about 25%. Or so within the next 2 or 3 years. And in other words, the mix of operating profits will be probably 75% terminals throughput, LPG terminals throughput, probably 25% or 23%, and the sourcing will remain 1 or 2%, something like that. So that gives you an indication. But it will. We would like the retail volumes to gradually increase their share. Because obviously very high margin, and that's what we're trying to do. But that gives you a sense.
Okay, sir. That was helpful. Thank you, sir.
Thank you. We take the next question from the line of Kashyap Zaveri from MK Investment. Please go ahead. Mr. Kashyap Zaveri, you may please go ahead with your question, sir. As there's no
Hello.
response.
Hello.
Yes, go ahead,
Yeah.
sir.
Yeah, we can hear you.
Yeah, sorry. Congratulations for really good set of numbers in challenging times, and thanks for this opportunity. I have just one question. In terms of our client on the gas division side, there has been a lot of talks about change in the some of the companies promotership. In terms of stake sale and all, how do you think that could impact our contracts with some of these names, especially when a few of the names which are being spoken about who have expressed the interest there are probably great executors of the capex themselves.
I could not actually understand your question. The line was bad, so could you repeat it? I could not actually understand what you said.
Is this better?
Yeah, that's better. Please say it again.
Okay. So what I'm saying is that in terms of some of our clients, there has been talk about divestment, and all, and some of the people who have expressed their interest in some of your clients, they are themselves great executor of capex, as we have seen in the past. So how do you see that in terms of our contracts with, our client? Does this impact us in any way, or, how do you see that?
Well, I'm not really exactly sure what you're referring to. So let's take LPG division, which produces 2/3 of our profits. So our clients are IOC, HPCL, BPCL. I don't see any divestments or anything from there. So that's going to continue as normal, and we are, as I said, we are a critical company in their supply chain of LPG. I don't expect that to change anyway. I think if you're referring to the liquid terminal division, we have many clients, 50, 60 clients plus nationwide, which are basically chemical manufacturing companies, which are traders, chemical traders, which are, again, the petroleum companies. We're talking about Reliance, SR or Nayara Energy, also IOC, HPCL, BPCL. So on the petroleum, I don't see any change. There's no change of ownership. They're going to continue, and they need the terminal space. On the chemical traders, to be honest, right now, don't see any change. And as far as the chemical manufacturer is concerned, look, ultimately, whoever owns them, they still need to have storage. If you're saying whether they can build their own storage and terminals, the point about this business is not whether they can do capex or not. Is having the right locations at the ports where there is no land now. I mean, we have been in this business in the liquid terminals business for 40 years or so. So we are at all the prime locations. So there's nobody who can really build over there because there's no land in most of those locations. So I don't really see that. I don't really see any evidence of that whatsoever.
So this BPCL thing, you don't think any impact could be there, if that divestment happens?
Well, look, whenever that happens, we were told supposedly it's going to happen by March 2020, so that didn't happen. Anyway, whenever it happens, if it happens, and I would argue whenever it happens and if it happens, there are a lot of crises going on in India right now. Anyway, I think the owner of BPCL, whether it is the government of India or whether it is XYZ coming forward, as far as LPG is concerned, they would like to make profits. They would like to sell LPG, and they would like to have the lowest cost LPG. That's why they will use Aegis, whoever is the owner of Aegis, on a commercial basis. And that's the whole competitive advantage of Aegis, that our strategy is to be the cost leader of imported LPG in India. So that's why they will use us to make the maximum profits. If anyone who takes over BPCL would be interested in profit maximization. If you don't think that's the case, then we can talk. But I think that's so. I don't think it really matters, because the thing about the LPG business is, it's all about logistics, and that's why we are in this business. And you need to get the LPG into the domestic consumer, and you need to make sure that supply chain is managed very well. So I think that's the competitive advantage that Aegis has, and irrespective of the owner, that's why we will continue to do business with BPCL and HPCL and IOC and many others in that business.
Okay. And just one last question. If I look at our logistics, as a percentage of the final price of the LPG, so if I look at our EBITDA per kg or EBITDA per ton, we would be just about probably less than 1% of the costing of the final LPG price?
Yeah,
or about 1.5%.
It's definitely small. I would not agree with that figure of 1%, and also it does change depending on the price. It's not a very useful measure because the price changes every month, etc. But let me give you a sense. Our margins for our LPG throughput logistics services, our Ebitda margin is around 1,000 rupees plus per metric ton, which has remained stable for some time. So that's the correct metric to look at. That margin is stable. It doesn't swing around. The prices go up and down every month, like Oil prices go every day. LPG prices change once a month, and that goes up and down. But if your point is it's a very small part of the LPG delivered cost, and we should look at the delivered cost to the end user, that is to their bottling plants,
Right.
which includes inland logistics costs. You're right. The throughput charge, and that's what we always tell our customers, that it's a very small part. So you're absolutely right on that. The figure I would dispute with is 1% because that obviously changes. But yes, it's a very small part, and it's a very critical part because if you're importing gas without this type of logistics infrastructure that we provide, you can't do it. So, but our goal is to maximize the throughput volumes. That's how we make the money, not to get into some price war or something that, we will charge 100 rupees per ton less, whatever it is. It's much more about how we can help them maximize the LPG volumes and imports in the country.
Sure. Thank you very much, sir, and that's it from my side. Thank you.
Thank you. We take the next question from the line of Rajesh Kothari from AlfAccurate Advisors. Please go ahead.
Good afternoon, sir.
Good afternoon.
Good afternoon, sir. I have 2-3 questions. Unfortunately, I missed your opening remark, so I don't know if you covered in your opening remark. During the last conference call, you mentioned about the uncertainty in the short term with reference to LPG volume logistics because of the huge import which was done by the HPCL, BPCL kind of companies. Do you see the stability in that from here on? And would you like to say from second quarter on, but how do you see the LPG volume logistics in terms of the volumes for us?
Yeah, I of course I'm not going to give a quarterly sales forecast, but I did earlier in the call, which you may have missed. I did say that look, we expect quarter 2 volumes. Obviously, we've just finished July, so I have some indication. We expect quarter 2 volumes to be better than quarter 1, in which was the peak lockdown period, and there were complicated, volatile things happening in LPG imports. But as the inventories wind down, those high inventories which were generated in April, May, June, we expect the LPG throughput to go up in quarter 2. But particularly from quarter 3 and quarter 4, we expect a jump in LPG throughput volumes for Aegis in our terminals because of the commissioning of those 2 projects, the Chakan pipeline, the maximum capacity reached in the Chakan pipeline, which is connecting Bombay, and the Pipavav volumes to go up because of the railway gantry project. So, in other words, we expect Q1 to be which had a throughput of 700,000 tons. My guidance is we expect Q2 to be better than that, and we expect Q3 and Q4 to be much better than that. That's the current indication.
Great. My second question is with reference to the since first quarter you have a marketing and distribution would have impacted significantly because of lockdown. So it is safe to assume that probably that segment would not have done or might be even a little bit lost some money from the
no,
second
we did not lose any money. There are no divisions in Aegis which lose money. That's a good thing. And we did not lose money in the retailing either because remember that the costs are pretty low here in the retailing division, which is a franchised operation. It's high margins. So even if you make 1 ton of photo gas sale, you still make 10,000 rupees a ton. So the break-evens are very, very tiny in that. So we even though there were very low volumes, for example, I mentioned in auto gas, we sold 2,944 metric tons in quarter 1 only. But still, multiply that by 10,000 rupees a ton, you still make a profit, Ebitda, etc., etc. So we made profits, but it was much smaller than the previous year. That's all.
So does it mean therefore your EBITDA per ton, which was, if I do on a blended basis, was roughly about 1,200, that probably would have a little bit reduced in first quarter?
I would not do a blended thing because lots of complicated things happening in different segments. We never advise people to do blended things because it just, I said stable margins, which means the margins for the throughput business, EBITDA was roughly 1,000 rupees plus, depends on which terminal. and stable margins for auto gas and the retail. The margins were stable. Obviously, there would be, I mentioned the total EBITDA for the gas division was slightly down. It was 77.9 crores versus 80.3 crores. That was a 3% drop in EBITDA. Clearly, a lot of that drop in EBITDA, most of it was because of retail, that there wasn't that much retail EBITDA. And some of it was, a small part of it was a drop in the sourcing, which is very small EBITDA, and then the rest, a small part was the small drop of 4% in the LPG throughput volumes. Quarter on quarter, year on year, of course, we still did see a 25% rise in the LPG throughput volumes. So anyway, in summary, it was bulk of the shortfall in EBITDA in Q1 in the retail was to do with the retail profits, which was
absolutely. And my last question is with reference to your slide on the retail targets over next 5 years. Assuming that we get to our targets, how meaningfully it can contribute to your EBITDA and your overall whatever the business strategy perspective, because I think this segment can be highly profitable for you.
Yes, it can be. I don't want to get caught into a 5-year profit target for the retail LPG, but what I can say, which I've said many times, so I can certainly say that again, is our current cylinder sales are very low, as you know, not only because of Q1, but still very low. But if we do reach hundreds of thousands of tons, and for now, let's just say, let's put a range of 200 to 300,000 tons of cylinder sales in 5 years' time. Okay, that's the kind of target that we have. Multiplied by a margin of between 3,000 to 5,000 rupees a ton EBITDA margin. That gives you a sense from that segment. As far as auto gas is concerned, we are currently, again, excluding the Q1 thing in the lockdown, but let's say we were at a run rate of expecting around 30,000 tons a year of auto gas. That is currently multiplied by a margin of 10,000 rupees a ton. So that is our current, let's say that was our current, if you exclude what happened in Q1 because of the lockdown. We expect that to go to 200 stations from 118 stations. So you can see that we are probably talking about going to 50,000 metric tons plus of auto gas sales from the current 30,000, multiplied again possibly by 10,000. So that gives you some indication of how important the profitability could be, for Aegis Group as a whole.
Great. Thank you, sir. Thank you very much. Wish you all the best.
Thank you. We take the next question from the line of Smriti Chindwani from Earth Capital. Please go ahead.
Yeah. Hi, Anish. Congratulations on a really challenging quarter. You've done pretty well in that sense that it's been a lockdown quarter. My question is that the EBITDA levels have grown despite the drop in volumes in LPG, and typically LPG contributes 75% of your EBITDA and 25% comes from liquid. So what exactly, if you could throw some color on the liquid division, that what exactly have you done in the liquid division so that it has compensated all the loss of volumes from the LPG? And my second question is that if this is what, I mean, as you mentioned earlier, that you were also pleasantly surprised because you were expecting softening in the liquid division, but it pleasantly surprised you that the liquid division has done much better. So if it continues like this for the rest of the year, and you also expect the LPG volumes in the second half to go up because of the additional capacities coming up because of the railway gantry as well as the Uran-Jharkhand pipeline, then we should expect this year to do much better than FY20 because you'll have more from the liquid, which you didn't expect, and in any case, you're expecting the throughput volumes to go up in the LPG in the second half. And the only thing which you're not expecting to be in line is probably the retail, which will take time to pick up. So should we expect FY21 to be a much better year in profits than FY20?
Right. Let me take up the first one. So yes, the EBITDA on the liquid side. Why did it do so well in quarter one, and what do we see throughout the rest of the year in the liquid division? And as I said, I was pleasantly surprised by that outcome. And I think that has definitely supported the overall group profits because the high performance of the liquid division. What I would say is the following. This is a result of two factors, the pleasing results of the liquid division. As I have been saying for a number of quarters, we have made a lot of capacity expansion in the liquid business over the last 2-3 years. The Kandla liquid terminal, 140,000 we added, 140,000 kiloliters we added over there. We have added 25,000 new terminal in Bangalore. We've added more capacity in Haldia, etc., etc. So I think it is correct that this investment has paid off now, and in fact we've seen even in previous quarters of the last financial year, it is beginning to pay off because we are beginning to handle higher value products. So what normally happens, the pattern when you build these terminals, it's not that immediately you can squeeze out the highest margins products. Because what you build the terminals, your first job in the first year is to make sure that you have pretty much 90 to 100% occupancy, and so that means you handle bulk products, etc., especially petroleum products which are lower value. But as time goes on, we are handling more and more specialty chemical products, etc. And that's, for example, the case in Kandla, which has been doing very well throughout this lockdown period in quarter one, etc. Again, Bombay has continued to do very well. So I think what I would say is that it's no accident that we have done well in this Q1 because the result of past expansion of capacity is paying off, and we're squeezing out more EBITDA out of these terminals. But the other thing which I did say, which I'll repeat, is the business model of this liquid terminal division is not dependent on throughput volumes, unlike the LPG business. It's not dependent on products going all over the country and the road tankers and all that. The business model here is storage based. So as long as the customers still need to store their raw materials or still need to store their products if they're trading it, etc., we remain full. And that is a good source of stability during tough times. So it was not really discretionary. In the hotel business, people can stop going as tourists to hotels, right? But for this business, which is storing petroleum, storing petrochemical storage of chemicals, even if, for example, in the month of April, most of manufacturing was shut in India, including chemical plants, but they still needed to store their raw materials. So that's why the business was good. And going forward into the rest of FY21, as I answered someone else just a few questions ago, again, I ask this question regularly with my conference calls. I'm in London right now, so I have to have conference calls with my liquid terminal team. They assure me that the outlook remains quite strong for the liquid terminal division, not soft, even going forward into quarter two, quarter three, quarter four, for the same reason that I said, that the customers actually, irrespective of lockdown restrictions, they need to keep their goods stored somewhere, and you have to do it for these type of goods. You need to store them. So I think that's the reason that the EBITDA has supported in these tough times the group profit as a whole. Now, you're wrong on expectations for FY21. At least wrong that my judgment is you're wrong. FY20, I would like you to recall, we had a stellar FY20. It was 57% increase in earnings per share, normalized increase in earnings per share. I don't think that you really believe that in FY21 that with all the problems that I mentioned, and I'll tell you specifically, that we expect a 57% increase in earnings per share in FY21. I really don't think that. It's highly unlikely because of things which I clearly stated. The biggest impact is that because of the COVID restrictions on retail, which is a highly profitable segment for Aegis. I don't know. We had very, very low figures for sales volumes in Q1. I don't know what those figures are going to be in Q2, Q3, Q4. It's impossible to forecast because that is purely dependent on government policy on lockdown restrictions in states, in cities. There's a patchwork of restrictions which come and go, so I really can't forecast, and no one can expect me. But let us assume that there will not be a big bounce back in retail sales volumes for the whole of the year. That's at least the safest assumption. Therefore, you're not going to see. Now, if it had been a normal year, there would be no COVID crisis. Actually, we were expecting a very good year in FY21. In retail was going to play a full part of that. But I don't expect at the moment, until things change, a big bounce back in retail. But I do expect, and you're right to say that because that's what I said, I do expect a good bounce back in our LPG throughput volumes, particularly in the second half of the financial year, not because of COVID or anything to that, but because of the coming on stream of these two major projects, the maximum capacity for the Chakan pipeline, Oran-Chakan pipeline, and the Pipa railway gantry, which is good news. And that will. But Q1 has already seen a small drop in LPG throughput volumes. I said that we expect Q2 to be better, but that means the first half of the year, Q1 and Q2, would be all right in terms of LPG throughput volumes. Q3 and Q4 will be a jump. But if you take the year as a whole, I think we do expect earnings growth for Aegis as a whole for FY21 because of Liquid Terminals Division good performance and greater throughput volumes in Q3 and Q4. But retail possibly not bouncing back. So I think it would be a good year if we can have some earnings growth in FY21, and we do expect that. But I don't expect that to be a stellar year like last year of 57% growth. That's, I think, the best summary I can give right now. And I think, quite frankly, if you look at the Indian corporate world, and I know you do, there are very few companies in India who can actually give a guidance that they're going to see an increase in profits this year. I think Aegis will be one of them. But I do not expect FY21 to be better than FY20 in terms of earnings growth percentage.
Thank you. Well, ladies and gentlemen, due to time constraint, we take that as the last question for today. I would now like to hand the conference over to Mr. Chindaria for his closing comments. Over to you, sir.
Yes, thank you for a good amount of questions. It's always nice to hear the interest. I think most of you summarized it well, so I will repeat your own summary that I think this was a decent set of results in challenging times in quarter one, but we have expectations of better times to come in quarter two, quarter three, quarter four in Aegis, in things. But we should not also be over bullish in thinking that, as I replied to the last question, that there will be an amazing year. I think that would be ridiculous in the circumstances. India is living through its worst crisis in decades, and I don't think. But I think where I am ready to give guidance, which is that despite that crisis that the country is going through, Aegis remains a strong performer in the circumstances, and even during the worst quarter that I think we'll have, which is April, May, June, Q1, we did okay. It was average, but I think we will do better in the rest of the year, and therefore I think that's a pretty good performance that we expect in the circumstances, and I fully expect. Again, I can't predict what will happen with coronavirus even in FY22. I don't know at the moment, But FY22-23, again, irrespective of COVID, we are trying to base our strategy irrespective of COVID. We do expect FY22 also to see a big increase in LPG throughput capacity with the Kandla terminal, LPG terminal. And again, we therefore expect to see earnings growth again in those years. And I hope that the whole country actually gets back on track by then, FY22. But I think FY21 is going to be difficult for the whole country, and I think. But at least we have held our own as far as Aegis is concerned, and I think we've performed well in challenging circumstances, and we're going to do better in the rest of the year. Thank you very much for attending, and we will have our next earnings call after the Q2 results.
Thank you very much. On behalf of Aegis Logistics Limited, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.